Hello everyone, welcome back to Banking and Finance with Chitrak. Today we'll be discussing the chapter Topical Issues Related to KYC AML and CFT, which is the fifth chapter of the second module, that is KYC. So, what are the topics that we are going to discuss? First of all, we are going to discuss about the interconnectedness of KYC, AML and CFT, that is the relation between all of these. Then we'll discuss about organized financial crimes, about the triad of organized criminals. We'll discuss about the common KYC for financial sector and the regulatory coordination for the AML CFT and KYC. So first let's discuss about the objectives. We need to understand the interconnectedness of the KYC with AML and CFT measures. We are going to recognize the risks of organized financial crimes and the regulatory responses, and appreciate the initiatives towards the unified KYC and sector-wide regulatory coordination. So these are the objectives of this chapter. Now the first part is interconnectedness of KYC, AML and CFT. Now money laundering and terrorism financing are distinct for certain purposes but have significant interconnections. What are those? Both money laundering and terrorist financing, they require a strong cover for their activities to be carried out successfully. This is often provided by a corporate or non-governmental organization, that is NGO structure. The large amounts of crime money are deployed in genuine businesses through Benami transactions, forging links between the criminals and the commercial world. Then terrorism activities are funded by organizations with large structured bodies running various commercial or social operations funded through criminal activities disguised as donations or investments. So these donations or investment can lead to both money laundering or terrorist financing. Now terrorism financing primarily supports the activities related to running organization and mobilizing support. The primary AML or CFT measure is ensuring and satisfying the genuineness of the customer and their activity, establishing true identity and conducting effective due diligence. So this is the main way how a normal branch head or branch employee can ensure that money laundering or terrorist financing doesn't take place. Then the effectiveness of other measures like the transaction monitoring and KYC review depends on proper due diligence. Now, what is the importance of ongoing KYC and transaction monitoring? You know that when we are in branch, we are told for continuous KYC updation. Even now, as of current date, RBI is conducting a re-KYC campaign for the KYC monitoring purposes. So what is the importance of this? Basically, transaction monitoring is the pillar of AML CFT regime. It enables banks and other financial sectors to report of suspicious transaction to FIU IND or FIU India. Gathered financial intelligence aids detection of criminal links nationally and globally via FIU sharing. So this is the importance of ongoing KYC and transaction monitoring. Now we'll discuss about the organized financial crimes. Basically, the organized financial crimes have been prevalent for a very long time, but in recent years it has been increasing significantly. Now the organized crimes have grown and it now causes mass losses and damages the public trust in businesses, because the transactions in businesses have transformed in such a way that you cannot separate the legal and illegal transactions in any business. So now we'll have a look in a different types and cases of organized financial crimes. First of all, we have a plantation scheme which occurred in 1990s, and several plantation schemes duped the gullible investors. Case 1, we have GFIL or Golden Forest Investment Limited, and it was a Chandigarh based company and it floated several investment schemes and issued post dated maturity checks. They claimed kher plants were used to be planted and they will invest the amount by the investors to make forests, and it will give the investors around 5 to 10x returns. So they accepted investments for about 1 to 23 years and they collected around 3000 crore starting from 1987 and for the next 10 years. But when the time for payments came, they paid around only 400 crores to the investors, and they siphoned a lot of amount for their construction work. So this was a major issue around that time. Even still now the case is going on and the investors are getting money little by little. Next we have a same kind of scheme in Gujarat. The scheme was floated and it promised 80,000 in return for an investment of rupees 500 for over 15 years by Golden Trees Plantation Limited. The company did not return the promised amount and paid only around 1100 to the investors. Next we had an interesting scheme called emu farm scheme. The emu birds, which is mainly found in Australia, there was a scheme which was flouted in Tamil Nadu's Erode district in 2006, which was farming of the emu birds. Around 300 crore to 500 crore of funds were lost due to this. First, we had a Susi Emu farm who promised a return of rupees 3.34 lakh within 2 years for an investment of rupees 5 lakh in contract emu farming. So basically 5 lakhs, they would return the principal, along with that a profit of around 3.34 lakhs. The company would rear chicks for the investors and pay them 7,000 per month and an annual bonus of rupees 20,000. So several emu farms mushroomed following the Susi Emu farm, and it exhibited processing facilities for the products derived from the emus. The firms claimed that the emu meats were exported and everything from emu was marketable. But the bubble burst very soon and it was realized that the scheme was unmarketable, and it led to the abandonment of investors by the promoters of the emu farms and including the Susi Emu farm. As a result, a lot of money was lost of the investors. Then we have some real estate and collective investment Ponzi schemes. So numerous investment schemes have been floated for collecting funds from the public with the lure of lucrative returns, siphoning the funds to the promoters and trapping investors into false claims. First we had the PACL or Pearls Agrotech Corporation, who collected funds from over 5 lakh investors in an investment plot or double their investment in 5 years. SEBI ordered the company to refund 49100 crore to the investors. Then there was a Speak Asia scheme which collected huge amounts of funds with the disguise of subscription for eligibility to participate in specific number of weekly market surveys. They promised a payment for successful completion of each survey. The scheme was designed such that the participant was promised double the amount paid for the subscription within a 6-month period. The amount then collected was remitted out to Singapore, where the entity was running the scheme. Such schemes use banking systems for collection of the funds from investors and then siphons the amounts collected to outside of India. So these schemes cause a loss to the general public. The RBI has advised banks to be very cautious and ensure that they are not used for carrying such schemes. Banks need to be alert about their customers and look out for the signs of the accounts with them being used for any type of money laundering or unauthorized collective investment schemes. RBI has advised the banks that they will be held responsible for the loss to the public if such signs are noticed and they still allow the relationship. Next we have the triad of organized crimes. So the triad of organized crimes consists of professional money launderers, organized criminal groups and terrorist organization. So currently all of these money laundering scammers work together. So over the years, the incidences of various crimes have been increased substantially, leading to a rise in the money laundering. Terrorism activities have also become widespread, causing a larger number of countries and more organized terrorist groups. Organized criminal groups or OCGs engage in various types of crimes, and terrorist organizations or TOs have found mutual interest in various forms as a significant source of fund. Now, with the advent or advance of the fintech, movement of these funds through financial systems has become more faster and easier. So technology has enabled evolving new modalities of disguising the money laundering or terror funding through the financial systems. This has become a skilled activity requiring innovative and new approaches, as well as several linkages with various individuals and entities who facilitate the movement of funds across the regions. So this led to the rise of professional money launderers who participate in organizing the movements or funds for OCGs and TOs. So basically the organized criminal groups and the terrorist organization use the professional money launderers to launder their ill-gotten money, which in turn helps them to promote or continue their terrorist organization activities. Now, as this process has become more complex, risking seeping into regular business transactions and now makes detection harder. So now the process has become so complex like I said earlier, it has mixed with the regular business transaction. So you cannot determine which business transaction is legal and which is occurring due to money laundering. So now the detection is very hard, and we need many new kind of skills and new kind of softwares to detect the money launderings. We'll discuss the common KYCs for the financial sector. So KYC AML measures are crucial for reducing the money laundering and terrorist financing risks. These measures cause a certain degree of hardship for the customers. KYC requirements are often perceived as a burdensome for customers, as they have to fulfill the same similar requirements repeatedly. To address this, the Subcommittee of Financial Stability and Development Council has recommended a common KYC system for the financial sector. In line with the PMLA rules, amendments have been made to provide a central KYC records registry, or which is known currently famously as the CKYC, and now it has been put in place. So what is the central KYC records registry, or CKYC-R? A new setup called the central KYC records registry has been implemented, and the Central Registry of Securitization, Asset Reconstruction and Security Interests of India, the CERSAI, acts as the CKYC registry. You know CERSAI because our land records have been kept at CERSAI, after which a lot of fraud related to land have been reduced. So they have been given the responsibility of maintaining this CKYC register. Now, this procedure ensures both uniformity in the approach to KYC and interusability across the financial sector. So, what is the function of the CKYC-R? It receives, stores, safeguards and retrieves the electronic KYC records from reporting entities as per the PML, or Prevention of Money Laundering rules, and it provides online access to the registered regulated entities, or the FIUs. What is the key operational aspects of this? The reporting entities file the electronic copy of the client's KYC records with the CKYC-R, and within 3 days of account-based relationship establishment. So, when you open the account, within 3 days you have to file the CKYC of the customer. Then the regulated entities maintain the physical copy of the records of identity of its client. CKYC-R deduplicates the data received and issues a KYC identifier for each client to the regulated entity. So the KYC identifier is a unique number. We also call it CKYC number to the customer. The REs communicates the KYC identifier in writing to their client. So the client is provided with the CKYC-R identifier. The KYC identifier is a unique number or code assigned to the client by the CKYC-R. For the purpose of KYC, a client submits the KYC identifier to a RE, and the RE retrieves the KYC records online from the CKYC-R. A client may also submit the same KYC records or information or other additional identification documents or details. So, if the RE who is getting the KYC identifier from the customer needs some more information about the customer, they can ask it from the client. Like I said, the REs may ask for further information if in situation where information is not available in the CKYC-R. Let's suppose the customer's voter ID number is not given in the CKYC-R register, or maybe the customer didn't had his PAN card while he first given his documents for the CKYC-R, but now he has the PAN card. So then the new regulated entity can ask for the PAN card and then upload the same to the CKYC-R. So, if there is a change or information of the clients as existing in the records of the central KYC records registry. Now, if the address of the customer or the surname of the customer has changed, then the new regulated entity can upload or change the same in the registry. The current address of the client is required to be verified. The regulated entity considers it necessary to order to verify the identity or address of the client, or to perform enhanced due diligence, or to build an appropriate risk profile of the client. Now, the regulated entity furnishes the CKYC-R additional or updated information obtained from the client, and CKYC-R will inform all REs who have dealt with the concerned client. The RE which performed the last KYC verification or sent updated information in respect of a client is responsible for verifying the authenticity of the identity or address of the client. Regulated entities cannot use the KYC records received from CKYC-R for any purpose other than verifying the identity or address of the client, or transfer the records or information to any third party unless authorized to do so by the client, the regulator or the FIU. Now, what are the benefits of the CKYC system? It eliminates the need for repeated KYC submission at various institutions. KYC update only needed once, and it saves time and resource sector-wide. Uniform information for individuals or entities cuts down misrepresentation risks. Central duplication helps detect multiple entities created by same people and weeds them out with better due diligence. So these are the benefits of the CKYCR system. Next, we have the regulatory coordination for AML, CFT and KYC. So PML Act and rules, these apply to all financial sector players, but implementation of standards vary by sector due to the nature of activities and different approaches of regulators. So there is a need for coordination. Why? To strengthen the effectiveness of the AML CFT measure, and the inter-regulator coordination is crucial. Now the operationalization of the common KYC registry for the financial sector will bring some uniformity in the KYC standard. It can also serve as a uniform customer identification code or UCIC for a persons across the financial sector. It helps in more effective linkage of transactions carried out by a person in different banks and other financial institutions. Now, for foreign institutional investors or FII, RBI and SEBI, they have jointly worked out a modality for sharing of the KYC documents by the custodian that does the KYC and due diligence on the FII with the banks where they open their accounts. So when they open an account in a bank, the FII do not have to provide the same KYC repeatedly, because the RBI and SEBI have jointly worked for a modality for sharing of the KYC documents between all the custodian of the FII. So it avoids the need for the FII to provide its particulars to multiple entities, and it ensures uniformity of the approach for customer. Another area for better coordination is sharing of the red flag indicators among various sectors. Linking indicators for transaction in bank accounts with those in other sectors, that is in insurance or mutual funds, helps for better detection of suspicious transactions. So we can think of the CKYCR system as a central ID card office for the financial services. Instead of getting a new ID card every time you open an account with a different bank or financial institution, and you get one central ID or KYC identifier that all approved financial institution can access, ensuring your identity is verified consistently and efficiently across the entire financial sector. So this is it for the 5th chapter of the KYC module of the IIBF AML and KYC exam. Next, we'll discuss its MCQ, and then we'll talk about the 6th chapter and not the AML chapter, because after the 6th chapter, the KYC module of this series will be completed. So stay tuned for the next video, which will be coming very soon, and I promise not to delay it like the previous time. All the best for your exam.